What if the multi-billion-dollar bailout doesn't work? It's vital, says the American president, to save the US and by extension the world from financial panic. But what if it's not approved? What if it's not enough? What if people just don't trust the idea? What happens then? This is Inside Story. Hello, I'm David Foster. The new force in finance is now the government. But lawmakers from both the Democratic and Republican parties in the US have voiced doubts about the Paulson plan and the speed at which they're being asked to approve it. They want assurances that it will benefit ordinary American homeowners as well as Wall Street and be subject to adequate oversight. It's financial doomsday if it doesn't work, says George Bush. Many in Congress are now determined that the leaders of big banks and financial institutions take huge pay cuts themselves if they want taxpayers to bail them out. The US Treasury Secretary Henry Paulson told the House Financial Services Committee that he understood the public anger over Wall Street executive salaries, but the immediate priority must be to save the economy.
If that situation were to persist, it would threaten all parts of our economy. Every business in America relies on money flowing through the financial system smoothly every day.
In another session in front of the Senate Committee on Banking, Ben Bernanke, the Federal Reserve Chairman, said the whole world is at risk.
Action by the Congress is urgently required to stabilize the situation and avert what otherwise could be very serious consequences for our financial markets and for our economy.
However, most of the Democrats, along with some Republicans in Congress, are opposing Bush's plan, saying its long-term effects are unknown and that it lacks detail and transparency. They're also worried about how much power the Treasury Secretary, Henry Paulson, would have.
The chief problem I have with this bill is the lack of supervision of the Secretary of the Treasury. He gets to make all the decisions. Now, there's discussion of having a review board, but that's an after-action review board.
The American public faces a massive bill, as much as $10,000 US per household. And that is the price, very, very hefty price that they will have to pay if this plan goes through. Let's go to New York. My colleague John Terrett is there. The United States is where so much of this began, where so much of it, John, is being played out. Is there a deal on the table? What is it that the various members of Congress don't seem to like?
David, there is a deal on the table and it's likely to be in place by the time the markets open for business on Monday morning. The thing is, it's going to be a very different kind of bill from the one first proposed by President Bush only last Saturday. It may well still be the $700 billion that the United States Treasury wants, but there will be many, many more provisos in there. The bill, as originally proposed, was just 3 pages long. It's now 10 times that size, and this is the direct consequence of mainly Democratic members of the Congress insisting that there is much more oversight. If they're to give the Treasury this money, then they want much more control of how it is spent and where. For example, there will be, we are told, some limits on executive pay. The Treasury will take a stake, a financial stake, an equity stake in the companies that come to it looking to have their toxic assets taken off their hands. And also there's now going to be direct help for homeowners. For example, bankruptcy judges are to be allowed to alter the interest rate on the mortgage of people who are struggling to pay their bills. So a very different kind of rescue package than was first proposed by the Bush administration. But after 4 days of wrangling in Congress, it now looks as if we are at least going to get a bill. And it's important because what is basically happening is that the US economy thrives on credit and confidence, and there's a very sad lack of both of those around at the moment. For example, the banks are just not lending to other banks because they can't be sure that those companies will be there the next day to pay them back. I mean, you can get money. It's true, you can get it, but it just costs you an arm and a leg. It's very, very expensive at the moment. And on Main Street here, on the High Street, people can't get student loans or car loans, and some mortgages are beginning to dry up. So until this situation lifts, we're going to persist with this problem. And the passing of this bill, should the deal be done, and I think it will go some way to alleviating that. David.
We'll come back to that in just a moment, John, but you've been expecting to spend a large part of your time these recent days at the United Nations on the other side of New York. Now, you've managed to pick up the drift of what they're talking about there. It was to have been mostly about aid to developing countries, but this is the hot topic and how it would affect them.
Well, I mean, you're absolutely right, David. I mean, this has been one of the most boring United Nations General Assemblies that I can ever remember. And I think it's partly the fact that President Bush, the host government speaker on the first day, of course, is effectively a lame duck president now. And he was banging on about, don't forget the war on terror when I'm gone. And I think world leaders rather switched off and says, oh, is he still here? Really, goodness me. But what has happened is that the financial crisis has knocked off the agenda all the things that we were expecting them to talk about and make headlines at the General Assembly, like reform of the Security Council, Russia and Georgia, and the Millennium Goals. Instead, leader after leader has come to the podium and attacked the United States for what is happening in the global financial world and called on the wider world to pull together to try and get us out of it.
Construisons un capitalisme où les agences de notation.
Let us rebuild capitalism in which credit agencies are controlled and punished when necessary. I assume my responsibilities by saying that those who placed people's savings in danger will be punished.
We must not allow the burden of the boundless greed of a few be shouldered by all. The global nature of this crisis means that the solutions we adopt must also be global. The United Nations must issue a call for a vigorous response.
John, you used a phrase earlier on which sent shivers through me, describing all this as toxic assets. I mean, that really sort of gives you an idea of how poisonous and all-pervasive this is actually going to be. Your feeling is that this plan will go through. It's all or nothing, really, isn't it? Because there isn't a plan B.
No, there really isn't, and we've known that from the start. And this is what's been so interesting to all of us here watching this, because every member of Congress pretty much has said, look, OK, we know we've got to have a bill, but they've been wrangling over these last 4 days on the specifics. I think it was really that they just didn't want to hand a blank check to President Bush and to Henry Paulson, the Treasury Secretary. And for the first time, we've seen the Congress pushing back against the administration. In the past, when they've come in panic to them and said, look, you need to give us money, you need to sort out this situation, it's a crisis, they have come running. And this time, at the end of George Bush's presidency, they're pushing back and saying, wait a minute, we want to see if what you're saying is really true. Now, assuming we do get this bill through the Congress and the Treasury is allowed to borrow up to $700 billion should it need it at any one time, what's the effect of this going to be? Well, it's going to remove the 800-pound gorilla from the room, because everybody knows that these banks and some companies are carrying this toxic debt, that it is a problem. If the bill goes through, all this could be lumped together, assuming they can work out the details with these companies into a central pot and then managed very carefully by the government, which is the only organization, of course, that has the patience and the funds to do this over many years. And it's perfectly possible that the government could actually end up making a profit on all of this at the end of the day. But one thing that's worth bearing in mind, when the dust finally settles from all of this, the fundamentals of the US economy still look weak. There is still a housing crisis with no bottom in sight. Unemployment is going up. There was another spike only on Thursday in the United States. Fuel prices, although they're down from their highs, are still extremely high for Americans, and there's a reluctance to spend in the shops because of all this uncertainty. And David, as you know, this economy more than any other relies on buying and selling in the shops to keep it going. So the fundamentals haven't really changed. David.
John Terrett, thank you very much indeed. One view from New York there. Let's get some more. Joining us, our guest from Tokyo, Mark Burgess-Watson, co-founder of Japan Invest, a firm that provides information about Japanese companies. In Amman in Jordan, Fadi Abdo, former head of wealth management at Societe Generale in Jordan. And in New York, Tom Au, market analyst and author of the book, A Modern Approach to Graham and Dodd Investing, which in 2004 warned of a series of stock market crashes followed by a global depression. Let's start with you, Mr. Au. Are we going to see a depression?
Yes. That's an ever-present possibility. Naturally, the Fed and the administration are doing everything in their power as we speak in Washington. They've even pulled the two presidential candidates off the campaign trail for consultations for the simple reason that the winner of this election will inherit this situation. So they're trying to fight it. It's not clear at this point whether they will succeed.
A depression, what's that going to mean for people?
Well, the last experience we had of a depression was in the 1930s. It's not necessarily a bad thing for all countries. Some developing countries actually learned to stand on their 2 feet, so to speak, during the 1930s pullback, and we're talking about an economic pullback. because they became more self-sufficient as global trade diminished.
Okay, let's go to Jordan now. Fadi Abdo is there. Fadi, what if this doesn't work? Is there anything else that could be done?
You mean if the bailout doesn't work?
Yeah, absolutely.
Actually, I'm a little bit on the pessimistic side. I don't think anything will work. I mean, even if they do get it passed, this bill, I don't think it will be substantially beneficial for the economy. Maybe it will give some temporary sedative injection for the market, but I don't think it will turn the whole course of events.
Yeah, because this is about confidence, isn't it? This isn't really about real money. Nobody's been tearing up dollar bills. Nobody's been throwing gold bars into the ocean. This is about confidence. People not willing to invest, people not willing to lend, house prices falling because people aren't willing to pay. So it's all about confidence. People have to believe in this.
Actually, it's both. I mean, confidence alone is not enough. There's a real matter on the ground. There is a bankruptcy in terms of lenders. There's no more liquidity as it used to be. There's nobody to finance. The major players are not there. I wouldn't say it's a matter of confidence. I mean, confidence is an important factor in the equation, but I would say it's like 80% fundamentals and 20% a matter of confidence. Even all the measures that the United States are trying to do at the moment is trying to restore the confidence, but they will be only trying to solve the 20% of the whole equation.
Mark Burgess-Watson in Tokyo, I know you look after the interests of a lot of Japanese companies over there. You know the situation rather well with Japan Invest. Tell me what the knock-on effects would be in the Eastern markets if this plan fails.
Well, I think that they'll be pretty negative, David. I mean, there's a great deal of blame being apportioned to the United States at the moment. But as we know, one of the problems has been what the economists term asymmetric growth. You've had too little consumption in the Far East and too much reliance on the US consumer, as has recently been described as the consumer of last resort. And I think if the consumer of last resort disappears, a lot of people over here are going to be left scratching their heads and rethinking their economic policies.
Well, absolutely. This is because
will
presumably,
be in the forefront of that.
Yeah, an awful lot of Chinese exports go to America. If those aren't bought, then the market will collapse in China. That we're seeing an awful lot of Japanese exposure to these bad debts because they've invested in some of these banks. It's the knock-on effects, isn't it?
Well, I think over here the financial exposure is less of a concern. I mean, the financial exposure in China and a number of these other developing economies, fast developing economies, if you like, a lot of that exposure is in US treasuries, which one hopes, for the time being at least, are still as safe as they ever were. But I think that it's the real economy impact that you'll see over here, David, because it's the cars being exported from Japan, it's the toys being exported from China. And as I say, if the consumer of last resort disappears in the US, that's a very difficult prospect. And the Eurozone itself is already seeing this. And of course, the Eurozone market is a big market for Japanese and Asian exporters as well. So I think that particularly as far as Japan is concerned, they've had a very serendipitous, shall we say, global outlook for the last 15 years to reform their economy and to get themselves out of the mess they fell into in 1990. And I'm afraid at the moment the jury is at best out on whether they've successfully done that. And with the global backdrop falling away pretty decisively now, the Japanese are really left on their own. And what we've been hearing over the last couple of days on the political scene here is not particularly encouraging, to be quite honest.
OK, Tom Au and the other guests too. I'm going to give you all a sentence which I'm going to begin. I'd like you to finish it. Tom, you first of all of this could have been avoided if
the Fed had not loosened the money supply in 2001, but that was a case where the Fed was looking at financial bronchitis, elected to fight the bronchitis, and in fact led us into financial pneumonia in 2008.
So short-termism, giving somebody a very serious disease. Fadi Abdo, this all happened because?
Yeah, too much leverage in the markets. Interest rates have been too low for an extended period of time. It's the capital system at its worst shape, too much leverage, basically.
And Mark Burgess-Watson, let me ask you this one. This can be sorted out if?
Golly, I've been left the most difficult one. I think if the financial package in the United States fails, then other countries are going to have to come off the sidelines, stop carping at the United States of America, and sit down and talk seriously about a multinational solution to this.
Now, all of this week, Inside Story has been exploring this financial crisis in a special series of programmes from around the globe. It all started in the United States, and in our New York show, the senior financial analyst Gregory Larkin shed some light on the current situation and possible causes.
I think there's a bigger trend here, which is that for about 10 years, real wages, especially in the two bottom quintiles of America, have been declining. Household savings rates, savings as a percentage of disposable income, have gone negative for the first time since the Great Depression, and debt-to-income ratios are at unprecedented levels. Americans are overstretched and earning less money, and in that context, this sort of a blow-up was inevitable. Combined with all the fraud and the overzealous and the over-aggressive expansion of credit, the risks were hidden in plain sight, in my view. We're definitely going to see, and it's remarkable that we deviated from that in the first place, is that banks are going to have to focus on getting their loans repaid. Now, it's amazing that that's new, but that's where we are. What's going to have to happen is a shift, and it's going to be a messy shift, and there are going to still be scalps, which is that when you extend credit, the objective has to be to get the money back rather than to close the deal and collect a fee.
Been a bit of a roller coaster ride on Asian markets of late. In Hong Kong, savers of the Bank of East Asia, they were queuing up to get their money out as rumours were spreading about the bank's exposure to the global financial crisis. Our correspondent David Hawkins in Kuala Lumpur. Let's look at that bank first of all, David. Is it in real trouble?
It appears not. There's a lot of fear and uncertainty and doubt in Asia about whether or not the financial crisis in the United States will spread here, and rumors were spread about this bank that it was in financial difficulty, that there were stability problems, that it didn't have enough money on its balance sheet to cover its debts. The bank's management and the banking authorities in Hong Kong have tried to dispel those doubts, and they've been pretty successful in doing so. The bank's stock actually rose 4 or 5% today.
Confidence and sentiment, David, it is always so much about that. And the markets in general, how are they reacting? Is it possible to read anything significant into the way they're behaving?
Well, today the markets were relatively stable in Asia. Most markets were down about 1% or a little less, except for China, where the market actually went up. But that was largely due to an unrelated issue. Chinese state companies bought back a lot of their shares, and that buoyed the market there. But throughout the rest of Asia, it was just slightly down. Everyone's waiting to see what's going to happen with this plan to bail out the American financial system.
David Hawkins, thank you very much indeed. Heading off once again round the world, let's go to Tokyo, let's go to Amman and to New York. Tom, in New York, in the course of the last 25 years, I was staggered to read that the financial services industry's share of profits in the United States has gone up from 10% to 40%. It accounts for 2/5 of all corporate profits in America. Is that because of deregulation, because there were no rules at all?
The share of financial profits has gone up because of the financialization of the United States. We've basically exported and offshored our manufacturing base, and most of what passes, or a lot of what passes for profits in this country is now trading, derivatives, and also the collection of interest on loans. General Motors does not make money on the cars that it sells to American customers. It makes all of the money on the loans that it makes to sell those cars.
So it's simply people swapping debt and paying each other for the right to do so. It's smoke and mirrors, really.
I agree. And that's why we're in the trouble that we're in.
OK, Fadi Abdo in Amman, is it possible, as some people have suggested in this world that needs some kind of regulation, to have any one global financial policeman?
Well, from practical standpoint of view, I mean, this is not doable. It's like asking for one central bank, one security exchange committee, Do you think that is possible? If we can do that, then yes. But practically speaking, it's not doable on Earth.
Mark Burgess-Watson in Tokyo. You've had a look at the Japanese market for us. What about the global position? We're hearing from the German finance minister and also the German foreign minister, Frank-Walter Steinmeier, that his government warned the United States, it says 2 years ago, that this was a problem waiting to happen. Were people lax? Did they not pay attention to the warning bells?
Well, it's a difficult one to answer, in all honesty. I mean, I think there are conflicting political and economic ideologies around the world, and I think the comments that came out of the German minister today really reflect a very European and well, Central European almost view of how economic policy should be conducted. And I think, you know, going back to your earlier question, I think that is one of the difficulties you'll have if you try and have a central regulator, because they all want this central regulator to do different things. European central banks, European countries will want a regulator to be much more interventionist, with much more of a focus on due diligence, on wages, on social equity, and so on and so forth. In America, you simply won't get that buy-in from the rank and file in the American legislature. I think in the UK, there's a sort of slightly uncomfortable halfway house. I mean, in a sense, you know, you've almost already answered your own question, because I think that if there ever were room for that one unified global regulator, then I would say it was the American Central Bank, and I think that they have been asleep at the wheel for several years, and that's really, in essence, the problem here. So no, I wouldn't agree that a whole load of regulation is what's required, and I think politically and practically speaking it's unachievable, but I think that had the American Central Bank had a different view of things and had raised interest rates much earlier than it did, we wouldn't be in the mess we're in now, frankly.
Gentlemen, thank you very much indeed. Well, in this special edition of Inside Story, we're about to take a short break, and when we return, we'll be looking ahead and exploring the future of a world economy. Stay with us if you will.